How do you not lose when you see craziness in the markets? Because the reality is we really haven't seen anything that crazy yet. I mean, yeah, we saw a little bit of a sell-off, but it's really not that big of a deal if you look at the grand scheme of how much the markets have risen over the last few years. And the way you do this is by understanding three things. Number one is how do you be prepared? Number two, how do you buy the right assets in the first place? And number three is how do you not get emotional? And if we start with how do you be prepared, the first thing you got to understand is what is investing? Investing is not a separate bank account that holds your emergency money. Investing is money that you don't need, that you put aside into these investments, and you think of this money as gone, that now you're working to grow this money. The reason why so many people end up getting emotional is because they look at their stock account as a separate savings account, as a separate bank account to keep your spending money. That's not what your stock market account is. Your stock market account is your investment account, it's your wealth building account, and that's separate. This is a long-term account where we're talking about years or decades worth of growth. You're going to see booms and you're going to see crashes. Stock market crashes are a part of our system. We have seen a recession pretty much every decade for the last century. The longest period that the United States economy has gone without a recession was after the 2008 Great Financial Crisis and the 2020 pandemic. Okay, recessions are a part of our system. Market crashes are a part of our system. You have to understand that these things happen. And so now when you understand that and you invest your money, you got to know that there will be times where markets go up and there are times where markets go down. This is a fact. It has happened for the last century and it will continue to happen. So now when you understand that, you will put different amounts of money in the markets, hopefully that we don't invest money that you need tomorrow. You don't want to invest money that you aren't willing to lose, because you got to understand that this money that you're investing is money that you're parting ways with for years, if not decades, that way your money actually has time to grow. Which brings me to part two, is how do you buy the right assets? If you notice in the beginning of this video, I talked about buying shares of the Dow Jones and buying shares of the NASDAQ. I didn't talk about investing in individual companies, because the reality is many companies went bankrupt during the 2000 dot-com bubble bursting. Many companies went bankrupt during the 2008 Great Financial Recession. Many companies went bankrupt during the 2020 pandemic. And if you invested your money into a company that went bankrupt, all of your money was gone. Your money went to zero. So now, if you're talking about buying the right asset, what that means is you got to know your investment strategy. For some of you, that's going to mean investing in individual companies, which means you're going to have to do the financial education to understand what you're investing in, keeping up with the financial statements and keeping up with the company. But that's the minority of people. What I like to say is 98% of people in America should not be investing in individual companies. So what do you do then? Well, the alternative is you can invest in a fund. There are funds that give you exposure to the Dow Jones. There are funds that allow you to invest in the S&P 500. The largest 500 companies in the stock market. There are funds that give you exposure to the NASDAQ. There are funds that give you exposure to tech companies. There are funds that give you exposure to AI companies. There are funds that give you exposure to REITs. There are funds that give you exposure to dividend-paying companies. There are funds that give you exposure to Chinese companies, Indian companies, emerging market companies. And so now, instead of investing in individual companies, what you can consider is investing in a fund, because now if you invest in something like the S&P 500 and one of the companies in the S&P 500 goes bankrupt, your whole fund doesn't go bankrupt. Because when Sears goes bankrupt and they're kicked out of the S&P 500, they're replaced by another company, and it's automatic. So now, when you're investing in these broader funds, especially if you're investing in the broader stock market, because there's also funds that give you exposure to the total stock market, well now, if one of the companies in your funds go bankrupt, you're still okay, because there are other companies in that fund to balance out the losers. So you lower your potential returns, but you also lower your risk. And if you're not willing to keep up with the company, if you're not willing to do that work, then you don't want to be investing in individual companies, because now you're taking on all the risk and you're just hoping for the upside. That's where the gambling comes in. If you don't want to do that, you can just invest in the stock market, because what we've seen happen over the last century is markets go up, markets go down. The people that don't know what they're doing lose when markets are going down, and then they start buying when markets are booming. That's not the game that you want to play. Obviously, if you can buy low and sell high, that's the best of both worlds, but most people don't know how to do that. And instead, if you just invest into the markets, well now, you're just investing in the stock market. When the stock market grows, you grow. When the stock market goes down, you go down, but you can use that as an opportunity to buy even more. And you don't have to worry about one company going bankrupt because you're investing in the broader market. So you can consider now investing in funds. And number three is don't get emotional, but I want to remind you before I talk about this that I am not a financial advisor. I'm just a random guy on YouTube. Everything that I talk about is not something I learned in a textbook. It's things that I learned from my own experiences and my own mistakes. I can't recommend what I do to anybody else, and I can't recommend what you do. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So now when we talk about don't get emotional, I said earlier, emotions are the enemy of profits. And the media is in the business of selling emotion. They're going to sell you that the world is ending, the market's collapsing, you got to get out while you still can. Or they're going to sell you that everything is great, everything is sunshine and rainbows, people are making so much money. Because those are the things that drive clicks. If they drive clicks, they drive ad revenue, and that's how these traditional media companies make money. So you gotta be able to separate through the noise and separate through the emotion, and also understand that recessions and market crashes create more millionaires than any other time. Why? Because they create buying opportunities. The stock market is the only place where when things go on sale, people stop buying. That's the place when things go on sale, meaning stocks go down, people run away. But when Macy's goes on sale, people line up. When you see a sale at Apple, if they offer sales, people would line up out the door. But when the stock market's having a sale, people run away and they sell and they panic and they say everything is a scam. This is where you got to understand the psychology of investing if you want to be able to build wealth. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.